Hey guys, this is Carlos Campos with Hope Street Funding and Realty. I have an interesting video today. I will be comparing the 7-year interest only loan compared to a 30-year fixed loan that's without prepayment penalty and fantastic loan for anyone looking to buy right now. So I will be using 2722 Grand Summit Road as the subject property. Of course, all of these scenarios that I'm bringing are based on specific terms and conditions, so keep that in mind. Rates do change daily, and I just priced this out literally 15 minutes ago, 7/3/2022. So on 20% down, we have a loan amount of 972. So 972, 20% down, the difference is that's the loan amount. For the interest rate, we have 6% on interest only loan. 6% is a little bit high, but it's a lot lower than perhaps a 13% rate on a $50,000 car that you're buying. If you have, somewhat good credit, let's even call it a 5% loan. You're still getting a really low rate. Now, the loan that I have here, a 30-year fixed, look at that, 4.25. That's fixed 30 years. Now, let's take a look at the yearly interest expense. Now, take the 4.25, that rate was available last year on a jumbo loan, which is still available to me and to you, or at least for one lucky buyer of Grand Summit Road, 4.25 rate. Let's take a look at the yearly interest expense. Yearly interest expense on 6% on 972, you're looking at 58,320. And the way we figure this out, we take 972, we multiply that times the interest rate, and that gives us our yearly simple interest. We divide this by 12, 4860. That's our actual mortgage payment plus taxes and insurance on this loan here, which is the interest only loan. Okay, that's how we figure out the interest only payment. Now we take the second loan at 972 times 4.25, we get 41,310. We see that the numbers check out. Yearly interest is $3,442. So the difference in interest is huge. It's $1,400 difference in interest that you're applying into this loan. So which loan would you take just from these two comparisons? Naturally, you would take the 4.25 because you're paying less interest through the life of the loan. So that's the first. The second thing is both loans are for 30 years, and here we have total interest paid life of the loan. It's here. This is for 30 years. You're gonna pay 749,000, and at the 7th year mark, right? Because you have a 7-year loan, you're gonna pay 408,000. Now you're saying, well, it's a 7-year loan, 6% rate. I'll refinance before then. True, you could. That's an option. Or the other option is, if your income is sufficient, you can probably pay this off in less than the 7-year mark. But why would you want to do that when you have a low fixed rate, and through the life of the loan you'll pay close to as low as possible compared to $410,000 that you'll pay with a 6% loan in 7 years. So let's see what you'll pay back at the end of the 30 years. Well, this is at the end of the 7th year mark because we're taking 972 plus the 408 240. That gives us 1380. Now we're gonna see that this number is not real and it's closer to the $3 million mark. But before we get there, we'll see how else we can compare this loan. So assuming that you don't pay any principal extra towards the mortgage, all things being equal, the savings between this loan, it's actually 341,000. Total interest paid in percentage, you're paying 29% in interest here in comparison to the 30-year loan, which seems to be a little bit higher, but in reality, we're going to see why this number is sort of a false comparison to this. Remember, at the end of the 7th year mark, we're assuming that this mortgage will be paid off or it will be refinanced and the interest will continue to the 30-year mark. So let's remove this at this point. So assuming we have a $200,000 yearly income, here we have $175,000 income on the loan on the right, loan on the left requires $200,000. This one requires a little bit more, and we see that our DTI it's a little bit lower, but we're doing that on purpose because we need to account for the fully amortized interest and principal payment, not just the interest payment. When you qualify a loan, you're looking for both principal and interest. This is how you qualify on an interest-only loan. On a fully amortized fixed payment here, we have a DTI of 42%, which means that essentially this loan would qualify with a lower income amount, 175,000, and this would represent a monthly income roughly around 15,000. Principal and interest 4781, taxes 1266, insurance $90, principal, interest, taxes, insurance 6137. Now from these two, which would you take? 6216 or 6137, including taxes and insurance? Now the someone may say, well, this seems good, right? But it may seem too good to be true for it to be real. Well, the truth is that you want this loan here because it's fixed for 30 years, and it will be great by the time that you take this property as your first time home, or maybe you're leveraging up, maybe 80% of the loan or 70% of the loan. But the point is that you move in, make some arrangements, you get the house to your liking, you take the low mortgage, right? And then you'll rent it out maybe in 2 or 3 years, or maybe even a year from now. Let's say, for instance, you put 30,000 into the house, 40,000 into the house, and you turn around and modernize the house in a fantastic neighborhood. This house will rent right now for 6,000, 6,100 year one. Look, 6,100 minus the payment, you're actually negative $37. The market's so strong that you'll probably pay out of pocket $37 your first year after when you rent it, right? This will be your cash flow after debt service. You'll be negative $37. Year two, assuming you come in, you follow the plan, you buy the house, you maybe fix it a little bit, right? Rent it out to a maximum $6,100 monthly. Year two, you come in and you increase the rent 7%. Your monthly cash flow then jumps up to 6527. So as you know, rents continue to go up, and you're allowed to increase between up to 8 to 9% per year, depending on your cost of living adjustments that you add. But normally, I see rent increases done between the 6 to 8% mark in California. Now, this property here, assuming you end up doing the rent strategy, you'll make $390 year two. It's not a whole lot, but the point being that you will have an option to have a low fixed rate, eventually lease it out, and most likely be able to tap into a different market, pull some cash out, and maybe have a line of credit to draw out some of the cash that you use, and have maybe an interest only payment on the second. Take out the cash and dump that into a new investment, maybe another single family residence where you can move into and do it all over again. So at the same time, your balance sheet continues to increase, and you're getting your investment career going by buying a property that, one, could be rented, two, could increase with the with inflation, but also with the current market, the way everything is. And the best part of that as well would be this. So this is how the 30-year fixed rate mortgage compares to a 7-year interest only ARM. So at the 7th year mark, this here is at the 84th payment. That's 7 years. This is when your balloon payment is due. And notice the balance continues to stay at 972 throughout. So theoretically, with a loan at 972 interest only, it will continue doing that. So even if you refinance for another interest only loan, guess what? Your balance will remain the same, or if not a little bit higher, because of the loan fees that you'll have, and also the new accumulated interest at the new interest rate. So in comparison to the 30-year fixed loan, we see a declining balance here, and this side that's all white is actually that's above here. It's all equity. As this continues to reduce, your debt is reducing because you're actually paying towards principal and interest. And here your balance is increasing your equity into the property. So eventually, at the 360th payment, you'll have your balance on your loan at zero, and your equity would be complete at whatever the market value is. Now, this doesn't factor in appreciation, but it focuses on something even way more important, which is the simple interest portion. See, we have here that your total interest repaid is $1,000,007 for 30 years, and this is $1,003,000 for 7 years. You still have to pay back the 972 plus the interest that you've accumulated up to year 7. But we're going to see that this number is actually true of this loan. But when you refinance and you end up doing another situation, or let's say, for instance, you can fix it into a 6% fixed rate with a principal payment. Look, we're gonna see that at the end of the at the end of the at the end of the term, we're gonna see that the actual balance here jumps up to 2.7 in comparison to the 30-year 4.25 program. You're actually saving $1,000,000 just by picking this loan compared to a 6% rate on perhaps a house that is turnkey, that's beautiful, and that's perhaps a little bit nicer than our loan. Well, pick our loan. We're gonna save you $1,000,000, and guess what? It's completely fixed for 30 years. You don't have to worry about your rate moving up and down. You don't have to worry about refinancing the rate. You don't have to worry about potential issues down the road. And 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 here you'll capture all the benefits of the appreciation, depreciation. You'll be able to write off the property. If you don't have a home, you'll be able to write it off. And compared to this area, if you want to come and rent in this area of Hillside, be prepared to pay 5,500 to $6,000 on a monthly property. I've even seen leases up to 20,000 about 4 or 5 miles from here. So yeah, this area is pricey, but guess what? You're getting a fixed rate mortgage, and you're getting phenomenal pricing when you do business with us. So I hope this was clear. I'm trying my best to explain this in a way that makes sense for you. But yeah, it's I've always been told to if something looks too good to be true, it probably is, right? But no, in fact, this pricing was from a few minutes ago. It's a fixed rate loan, 30-year fixed loan with no prepayment penalty. In fact, after 90 days, you can turn around and sell it and be okay. It's a traditional, conventional financing loan. It's the same thing as the other interest-only loans that are being offered right now. And it's a fantastic program. Look, you save $1 million. So yeah, what would you rather have? A 6% rate with a house that's completely turnkey, or would you rather save $1 million and maybe make your own fixes as you go? Maybe invest 50,000 in fixes and get it 50, 75,000 in potential fixes and have the house that where you can live comfortably in a nice location, certainly with a lower rate than what the market's even offering. 4.25. I mean, good luck finding that. So, well, this is Carlos. I am the president CEO. If you need anything, any questions, please leave a comment, subscribe, help me build my channel. We're bringing low interest rate loans to um, to great borrowers such as yourself, and also if you are interested in joining our buyers list, please follow the link below and also send me a text message. Let's connect. 424-201-0101. You have my email address, carlos at hopesf.us. Please hit follow, subscribe, and yeah, let's save some money here. A lot of people need low interest loans, and if you know anyone that's interested in buying, please refer them the listing of the property. It's down below. Feel free to use your Gmail to log in. We won't ever sell your information. It just helps me to add you to my CRM, where I can find out who's interested in doing what and who's interested in saving. Who wants to save $1 million? I know I do. And right now I have the ability to help out one lucky person. So help us, refer us, and we will give you guys the absolute best loan available. This is lender paid, and technically what that means is that you won't have to pay out of pocket for it. So even then, this is great. On this loan, currently, even for the lowest rate, borrower paid options means that you have to pay the origination fee out of pocket, and we're saving you tons and tons of money. So give us a call. Let's connect. Let's get you into Grand Summit today. And it's one of the benefits of being a vertically integrated company. And this is exactly why I set this up the way I did. So it's Hope Street Funding and Realty. We do both loans and real estate. And we're here to help you save as much money as possible. Thank you. Thank you for subscribing. If you're a seller looking to sell and you want these rates for your borrowers, we can push these for you as well. Please follow the seller page. We're more than happy to take you on as a seller and get you excellent buyers with excellent loans. So thank you. Subscribe, like, and share. Talk to you soon.